Thanks for clicking. All eyes were on the Bank of Canada this morning as it was set to make its first interest rate announcement since raising rates by 25 basis points back in July, with premiers from both BC and Ontario pleading with the bank to keep interest rates unchanged in order to help Canadian families.
I have to choose one of you.
We received our update at 10 a.m. this morning when the bank opted to hold interest rates at 5%.
Yes, I told you so. I warned you this would happen.
However, as we'll see, this was a very hawkish hold, and the bank did not rule out future rate hikes, potentially hoping to avoid some of the front-running that we saw the last time the Bank of Canada paused. So what I want to do today is go over the bank's decision, discuss some of the hawkish language contained in the policy announcement, and then go over what to look for next. Speaking of next, Bank of Canada Governor Tiff Macklem is expected to speak tomorrow, where he will no doubt go over the policy announcement and where the bank sees the economy going forward. We'll obviously have an update out on that speech on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this announcement. Onto the announcement. As mentioned, the Bank of Canada held its policy rate at 5% this morning, noting the excess demand in the economy and the lagged effects of monetary policy. So yeah, the bank is referencing the recent data coming from Stats Canada that show that Canada's GDP contracted in the second quarter of this year, bringing Canada closer to the highly anticipated recession that the Bank of Canada has been calling for. And, just as a brief side note, as there appears to be some confusion from the usual suspects, those in the real estate industry, a recession requires 2 consecutive quarters of negative GDP growth. So, while Canada has had 1 quarter of negative GDP growth, it requires another one in the third quarter for us to technically be in a recession. This is the traditional definition of a recession and can be found in any Intro to Economics textbook.
The is that?
Regardless, the central bank noted Canada's slowing economy in its decision to hold rates at 5%. The bank also said it will continue with its process of quantitative tightening, allowing those hundreds of billions of dollars of bonds that it purchased during the pandemic to slowly drop off their balance sheet, meaning they're letting those bonds mature, letting the government pay off what is owed, and aren't buying any more.
Now I gotta turn my back.
In what is being called very hawkish language, the bank noted that it is somewhat concerned with the lack of progress in Canada's core inflation rate. Core inflation, which strips out more volatile items like food and gas, have been showing very little downward movement over the past few months and have been remaining sticky. In addition to Canada's core inflation rate, the bank said it would be keeping an eye on inflation expectations, wages, and corporate pricing behavior. So, the central bank is holding on rates, but this isn't a pause like we saw the last time. This is a bank which is very much leaving the door open for more interest rate hikes should it deem them necessary. With that said, although we did see very hawkish language, and very well might tomorrow as well, similar to last time, this probably won't stop the usual suspects from calling for interest rate cuts, or at minimum, announcing the for sure end of the Bank of Canada's interest rate hiking cycle.
They should be cutting.
Cutting?
Yep.
Seriously, literally 3 minutes following the announcement, I timed it. But, although calls for rate hikes are likely to emerge more and more in the coming days, weeks, and months ahead, and FOMO is definitely going to be pushed.
Yeah, he got me.
Similar to last time, the hold from the bank doesn't necessarily mean that we're out of the woods just yet. First, the inflation expectations explicitly mentioned by the bank. There's a growing worry out there in the US and in Canada here too, that inflation expectations are growing. Canadians could be worried that tomorrow's prices are going to be higher than today's. And with oil prices at a 10-month high, even the bank noted in its policy announcement that this is likely to lead to the appearance of higher inflation in the months ahead. Given that the bank just held on rates, and at first glance it's going to look like inflation is re-accelerating as prices continue to go higher, as gas prices continue to go higher, it is possible that these inflation expectations could also re-accelerate. Further, wages. Wages this year have been accelerating at a faster pace than the rate of inflation, and a new report just released this week showed that they are expected to continue to rise in 2024, going up 3.6%, above the Bank of Canada's target rate. And if all of this sounds very familiar, it should. As in the wake of the bank's pause back in March, it was explicit that if the CPI didn't move in the right direction, it was prepared to do more.
Evidence accumulates suggesting that inflation may not decline in line with our forecast. We are prepared to do more.
And then, following this warning, everyone took the pause to mean the end of rate hikes. The markets took off, everyone tried to front run the central bank, and we saw more hikes again. So, While the bank is seeing some encouraging signs, depending on how you look at it, although the bank is seeing some encouraging signs in the GDP data, in the unemployment data, we're not out of the woods just yet. Regardless of the concrete predictions we're going to hear in the coming days, weeks, and months ahead, this is a very uncertain time. This is a time which is very much data dependent, and the Bank of Canada could very well hold. They could very well continue on with this hold, but they could also raise rates again. It will all depend on the CPI, which, as we've seen, can remain very sticky and surprise to the upside. It will depend on inflation expectations, wages, and of course, prices. While all of this is uncertain, the only thing that is somewhat certain, at least for now, is your budget. So, when deciding on what and when to buy in the real estate market, and which rate you choose, make sure everything fits within your budget. When all is said and done, you know your budget much more than anyone knows about the future of monetary policy. With that said, we should have a much better idea of the future of monetary policy tomorrow when the Bank of Canada Governor Tiff Macklem gives his speech, and we'll obviously have an update out on that speech on this channel. Click like and subscribe if you want to get that update, but for now, thanks so much for watching.